too big to fail. Throughout history, few institutions have wielded as much power as the banks. Their story begins here, in the ancient world, where the first traces of banking was born among civilizations like Babylon, Egypt, and Greece. It was in these fabled lands that merchants and traders first began to extend credit and to trade, igniting the flames of modern finance. From the ancient world to the modern era, these titans have shaped the destinies of empires and nurtured the dreams of visionaries. From their humble origins, banks evolved into the titanic forces that would shape the very course of human history. And that brings us to today, where technology like ChatGPT can create some scary epic intros. I mean, you still have to edit the videos, which takes a really long time, and it's not always right, but it's pretty good. Still, you know what the most powerful thing a bank actually has? It's not our money, it's trust. And in 2023, it looks like the slow collapse of the trust in the financial banking system. You see, banks have a lot of power and a lot of money and influence, but their Achilles heel is something that can't be bought with money, and that is trust. And this year, we've had Silvergate, Silicon Valley, Signature, First Republic, and even Credit Suisse, whose stock has lost over 90% from the peak of $74 before the financial crisis, all the way to now, where it's hovering around $2 a share. Today, of course, we know that all of these banks have either been rescued, backstopped, bailed out, or otherwise. But still, the entire backbone of the banking industry is its trust. And I want to show you just how big of a deal this all really was, specifically through the lens of Credit Suisse, because even though they were rescued, they will still have a huge effect on the entire banking industry because it only buys them time. Now, Credit Suisse is not a very popular bank here in the US, so why does it matter all that much that they were just on the brink of collapse if they got rescued and if most of us are probably not banking with them? And it matters because this bank was just one of 30 banks in the entire world that had the title of something called G-SIB. That stands for Global Systematically Important Bank. The literal definition of that title is a bank whose systemic risk profile is deemed to be of such importance that the bank's failure would trigger a wider financial crisis and threaten the global economy. In other words, it's too big to fail. And if it fails, it will eventually affect the European banks, which by extension will eventually affect the US banking system. That's why the US Treasury is looking at which banks in the US had exposure to Credit Suisse. And spoiler alert, a lot of them did. It's just a matter of how much. And that's why you might have seen this chart, the one-year price on credit default swaps or CDSs, which is basically the price to insure Credit Suisse's bonds from default. The higher the risk of default, the higher this chart goes. Just for context, here's the size comparison of SV Bank versus Credit Suisse. At the end of 2022, SV Bank had $212 billion in assets. Credit Suisse had $912 billion. Though that was at the end of 2020, and as the years went on, things got progressively worse. Just take a look at their income. The net income of a company is extremely important because it shows people how much money a company is making. And chances are, investors and clients don't want to do business with a bank that's losing more money than it's making. In the last 10 years of financial statements, after calculating their profits and their losses from every year between 2012 to 2021, they have made roughly $5.7 billion net. But in 2022 alone, they lost $8 billion. So in 1 year, that means they lost more money than they made in the last 9 combined. And that kind of data doesn't inspire a lot of investors and depositors to keep their money there. That's partially why they went from $912 billion in assets at the end of 2020 to $574 billion at the end of 2022. Of course, today they probably have even less than that, but still, their asset management portion of their business still manages roughly $1.7 trillion worth of assets. That means, to this day, they still manage for other companies roughly 8 SV banks worth of money. And for that reason, they're not allowed to fail. But in the meantime, their stock is crashing really hard for one big reason. The Saudi National Bank, which is their biggest investor, and they publicly announced they won't be providing any more money. They already own 9.8% of Credit Suisse, and if they owned 10%, that would make them insiders of the company, which would subject them to a completely new set of disclosure rules, which they don't want to follow, so they won't help.
We would not go beyond 9.9. Even if we desire to, there are too many complications from a regulatory and a compliance point of view globally.
That's why the share price went down right after their announcement. But Credit Suisse still won't be allowed to fail because right now they're getting what's called a backstop liquidity injection from their parent bank, the Swiss Central Bank. Right now they're borrowing over $50 billion in case they need to process those customer withdrawals. And what's crazier is, just as I was making this video, there was another bank that's headquartered here in the US in San Francisco called First Republic that got a liquidity injection of $30 billion by 11 other banks. Now, this is not considered a bailout. It's what's called a backstop, which is a preventative measure, but that's still not good news because we're seeing this domino effect play out and it's only getting worse. So the question is, how did things get this bad? Let me explain. But first, a quick word from today's sponsor. Personally, I'm a boring broad market index fund investor because I never learned how to trade like a pro. But with today's sponsor, Webull, you can learn how step by step. Webull is a commission-free trading app where you can trade stocks and ETFs without paying any commission fees. And with no account minimums, it's easy to get started with building your portfolio. With Webull, you can access real-time market data and stay up to date with the latest news and trends so you can make the most informed decision about your investments. You can also take advantage of advanced charting tools and technical analysis indicators to help you identify opportunities in the market. Webull also has over 35 million users worldwide, and it looks like they're here to stay. They've even been featured in publications like Forbes, Barron's, and CNBC, and if you sign up and open an account today, you'll get 2 free fractional shares, and if you deposit any dollar amount, you can get up to 10 free fractional shares that are worth between $34 in value all the way up to $30,600 in value. So click the link below in the description of this video to sign up and start investing today. Thank you, Webull, for sponsoring this segment of the video. Now let's get back to it. So there's a couple reasons why Credit Suisse is failing, and some of those are not at all the same why some US banks are failing. In 2009, for example, Credit Suisse tried to bypass US sanctions and were fined $200 million. In 2014, they tried to evade US taxes and were fined several billion dollars. In 2021, they lost over $5 billion thanks to their investment with Archegos Capital. That same year, there was a failed finance company called Greensill Capital, which cost them $10 billion and their clients close to $300 million. But the list of sketchy business practices that they have been involved with is extremely long, and I'm surprised it's taken this long for their clients to finally start pulling all their money out. And now, of course, with the collapse of the other banks, is making people lose their trust, and it's only making things a lot worse. But there's also another, simpler, much more elegant, and terrifying reason for why things are happening. And here's the explain it like I'm 5 version, and I hope someone turns this into a movie. After the Federal Reserve dropped interest rates to 0 to revive the economy, it created a huge surge of record high inflation. It was basically free to borrow money. And that created insane amounts of excitement in the asset markets, and people started to speculate on everything they could get their hands on. So to stop people from doing that, the Federal Reserve started to increase their interest rates, and that's what shocked the global financial system. And now we're starting to find out just how interconnected the entire banking system actually is. When the United States increases its key or federal fund interest rate, the entire world takes notice and has to follow. And that's because it makes specifically US assets like treasury bonds be some of the safest and best investments anyone could ever make. Think of it like a dividend stock that starts to pay you a guaranteed 5% return on your money. That would make it a really juicy investment, but not just for you, the retail investor, but also for foreign investors and countries around the world. You see, if a country like Russia started to increase its rates higher than the US's, the entire world is not just going to park their money with Russia because they wouldn't necessarily trust that system from collapsing, in the same way that you might not trust a stock like Enron to be paying you a 10% dividend yield. But it's not just about the interest rate. It's about the perception of stability and trust. The US dollar is a global world reserve currency. The world not only trusts dollars, it also needs them to purchase commodities like oil, which powers everything. So when the US increases its own interest rate, the rest of the world has to stay competitive by increasing theirs as well. If they just allow the United States to increase theirs without increasing their own, the United States financial system would act like a black hole, sucking up all the currencies and all the financial investments from foreign investors around the world. And that's a bad thing for other countries because if you're a central bank of another country, you prefer to keep your capital in your own country. So that's why they have to simultaneously raise those rates in order to stay competitive. But there's a huge side effect of raising those rates because you risk breaking the financial banking system and losing people's trust of it. The hardest job in the world right now is this guy's, Jerome Powell, who has to decide between bringing prices down, bringing inflation down, which is done by raising interest rates, or now potentially not breaking the entire financial banking system. Which one are you supposed to choose? Because if he picks to lower interest rates to save more banks from collapsing, then he could risk bringing inflation back to its 40-year all-time highs. And no one wants to pay more for literally everything. That makes people really upset. On the other hand, if he increases interest rates, which the market is predicting there's an 80% chance of him doing that at 0.25% next time, then that means potentially breaking more banks, which means more potential backstops and more potential bailouts. So then the question is, where are you supposed to keep your money? To understand that, just follow the money is how I like to look at it. Right now, the top commercial banks in the US are seeing billions of dollars in deposit volume. Banks like JP Chase, Bank of America, Citigroup, and Wells Fargo are just some of those examples. Those banks are perceived to be a lot more stable. Remember, these huge banks are considered G-SIB. Remember, global systematically important banks, which means they won't be allowed to fail. There will be a backstop before that happens, or a bailout even if it does. But regardless of what happens, it will still leave a really interesting question. What will it cost the taxpayer? When a bank fails, it's the Federal Deposit Insurance Corporation's job to make the depositor whole up to $250,000 at no cost to the taxpayer. But since taxpayers are also the people who deposit their money into banks, which is partially how the FDIC gets funded, then there is an argument to be made that even if it comes to a backstop and not a bailout, that taxpayers could front some of those losses, especially if banks decide to increase their fees on bank accounts or lower the incentive structures. That's why you might be seeing comments that say, privatize the gains and socialize the losses. In either case, double check your accounts to make sure you don't have more than $250,000 in any one of your accounts. I want to make a correction from my last video. Instead of separating into separate accounts in the same bank, make sure you separate across different banks so you are fully insured by the FDIC. Just like I've been saying in my last few videos, the fallout from these increased interest rates is only getting worse. It's just shocking to me that while I was making this video, another bank had to be rescued, and maybe more will come by the time you're watching this video. So please stay safe, please be careful, and in the meantime, I want you to have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. See you soon, bye-bye.